Hey guys, this video is being made to help explain MBS or mortgage backed securities, what they are and how they operate. You'll see on my video here that I'm on the Mortgage News Daily website. This is a public website, and I've referenced an article here that's going to help explain MBS. I use this website daily to track the market, track mortgage rates, get market commentary and insight on which way ultimately rates will be going, which starts out with what is an MBS. So what is an MBS? They are mortgage-backed securities. These are securities comprised of groups of similar mortgages, also known as pools. You may have heard the term pools before. This is where mortgages are ultimately bundled and bought and sold on the secondary markets on Wall Street. These items that are being sold are bonds or mortgage-backed securities. Mortgage-backed securities are bonds. So they're being bundled and sold, and essentially they are called, and for that reason, they're called pools. So that is why that's referenced here. You may remember there were some bad pools back in 2008. You couldn't tell what were the good loans from the bad loans, and that's what ultimately led to the market crash, which we can talk about at a later time. But that's where people really became familiar with pools. We are still bundling or selling pools of mortgages to Fannie Mae and Freddie Mac, the agencies on a national level. But this time around, since the Dodd-Frank Act and many other legislative laws and regulations have been put in place, they simply aren't going to have the collapse that we did back then in 2008. You have to have the credit and income to qualify. But that's in regards to pools. So MBS function, like I was saying, similar to other bonds. They are bonds, and that they have a purchase price and pay the investor back installments based on the yield. The price always refers to the cost of buying $100 of that particular bond. So for instance, if the price of a bond is 101.00, then an investor is going to pay $101. And in exchange, they would own $100 worth of that bond. So why would you pay more when you only own $100? Well, that word is yield. So yield is the rate of return paid on a bond over time. There are multiple different types of bond. Each bond has a certain yield that it pays. You'll sometimes hear us reference yield as a coupon or issue. That is in regards to the mortgage-backed securities. You might guess the higher the yield, the more the buyer will make over time. So the more the buyer is willing to pay. So for instance, if a MBS with a 3% yield costs $104.50, the investor pays $104.50 for the ability to collect 3% interest on $100. Conversely, yields that are lower may actually have prices under par. Par is 100, break even, meaning that investors could buy $100 worth of MBS at a discount. So the higher the coupon of the MBS, the higher the price will generally be. And I can show you that here. If we look on this page on the 30-year fixed mortgage-backed securities, you see the yields 1.5, 2, 2.5, 3.5, 4, 5, all the way up to 6. And as these yields increase, you can see the price column here. It goes from $70 or 79.06, and these are the dates on which these for this particular coupon or issue, like we were talking about earlier. But you can see how it goes up. It just gradually goes up in price. So the higher the yield, the higher the price. And here's two examples of that. So, and there's two ways to look at this. So if you're looking at an individual MBS, so just one coupon, like I was showing you here, you can see how the price changes. So as the price goes up, the yield goes down because it only pays back a fixed amount of 4.5%. Which is what they're saying here. The price going higher, then the yield for the investor goes lower because they're paying for a higher price for the same coupon yield. This is what we mean as prices go up, yields go down, which is a different concept than a higher yielding coupon fetches higher prices, like I was just showing you. So as you go to a higher coupon and the yield goes up 4.5, 5, 5.5, you can see it's going to fetch a greater rate of return, but it's also going to cost more or require more of an investment up front. So that's a little bit different, and that's what these two cases here are basically explaining, that the differences between those two concepts. But bottom line, coupon yield of a particular MBS only determines the rate of return for whatever principal amount remains in the MBS pool purchased by the investor, meaning buyer beware, because the duration of a mortgage can vary. Borrowers can sell, refinance, foreclose. So even though they may be buying these mortgage-backed securities or bonds with this amount of return, and this is why MBS are more risky than other bonds or treasuries you may read about in the markets, they aren't guaranteed this return, because if somebody refinances that mortgage, because these are tied to mortgages, real people, if they refinance or pay off the house, they don't actually get that full return, which we'll talk about a little bit more in securitization. And when we explain more about mortgage-backed securities, how they are bonds and how all that works in another episode here. But, for this introduction to MBS, we've explained, pretty much what they are, how they operate like a bond. And here's one last example here. So a mortgage can vary, like we were saying, the actual yield that an investor receives will depend on how quickly loans and MBS pools will retire. Like, suppose you paid $104 for the right to collect interest on a $100 loan. If the borrower pays you back before their first payment, now you've earned $100 for your $104 investment. That's not a good deal. So you're realizing a much lower yield than what you actually paid for. That's why sometimes with me as a mortgage loan originator, if you pay off your loan within the first 6 months, I actually have to pay back any commissions earned. It's a payoff penalty. A lot of our 30-year fixed products do no longer have prepayment penalties, but we as the originators can be required to pay back our commissions because that investor who purchased that mortgage-backed security in the secondary market did not realize their full yield or get their full return on their investment. So that's the basics of MBS. We'll go into a little more detail in some other episodes. I hope it helped you learn a little bit more, and feel free to reach out with any questions anytime. Thanks.